Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Understanding Value at Risk, VaR, for effective risk management. Value at risk, or VaR, plays a crucial role in understanding the potential losses in an investment portfolio. It's more than just a number. It's a powerful tool for risk management that helps investors make informed decisions. Ever wondered how much you could lose in a worst-case scenario? VaR gives you a clear picture. This metric estimates the maximum potential loss over a specified time period at a given confidence level. In this video, we'll break down what VaR is, why it matters, and how you can apply it to strengthen your investment strategy. Whether you're a seasoned investor or just starting out, grasping this concept can enhance your risk assessment skills and help you navigate the complexities of finance with ease. Get ready to uncover the insights that VaR brings to investment management. What is value at risk, VaR? Value at risk, VaR, is a widely adopted risk management tool that quantifies the potential loss in an investment portfolio. By estimating the maximum loss over a specific time frame at a certain confidence level, VaR provides a clear snapshot of risk exposure. For example, if a portfolio has a one-day VaR of $1 million at a 95% confidence level, there's only a 5% chance that the losses will exceed $1 million in a single day. This practical metric helps investors and financial institutions make informed decisions about risk management. Historical background of VaR. The journey of VaR as a risk measurement tool began in the late 1980s and early 1990s. It was during this period that financial firms recognized the need for a standardized approach to measure market risk amid increasing volatility and complexity in financial markets. 1990s adoption. Banks and investment firms began using VaR to comply with regulatory requirements and to assess the risks in their portfolios. Initial methods relied heavily on historical price data and simple statistical calculations. Development of models. As technology advanced, more sophisticated models emerged, enhancing the accuracy of VaR calculations. Techniques like Monte Carlo simulations and parametric methods became common tools in the financial toolkit. Regulatory focus. The 1996 amendment to the Basel Accord highlighted VaR, pushing financial institutions to adopt this methodology for calculating capital reserves against market risk. It marked a significant shift towards quantitative risk management practices. Today, VaR remains a cornerstone in risk management frameworks, evolving to incorporate various asset classes, market conditions, and risk factors. Importance of VaR in risk management. VaR is crucial for financial institutions as it serves multiple purposes in risk management. Quantifying risk. VaR allows firms to quantify their risk exposure in monetary terms, enabling better communication with stakeholders and facilitating comparisons across different portfolios. Setting risk limits. By determining potential losses, VaR helps organizations set risk limits for traders and portfolio managers. This ensures that risk-taking remains within acceptable bounds. Strategic decision-making. VaR aids in strategic decision-making processes by providing insights into risk-return trade-offs. Investors can make more informed choices when allocating resources among various investment opportunities. Regulatory compliance. As regulatory bodies increasingly demand transparent risk assessment practices, VaR helps firms adhere to regulatory standards, ensuring they have sufficient capital to cover potential losses. Using VaR effectively empowers financial institutions to navigate risks proactively and create robust strategies for investment management. It turns vague notions of risk into concrete data, transforming the way risk is understood and managed in the financial world. Types of value at risk. When it comes to calculating value at risk, VaR, various methods can be employed. Each method has its strengths and weaknesses, making it essential to choose the one that fits your needs best. Let's explore the leading approaches to calculating VaR. Parametric VaR. The parametric method is perhaps the simplest approach to calculating VaR. It relies on statistical concepts, particularly the mean and standard deviation of asset returns. Mean. This is the average return over a specified period. It serves as the central point of your return distribution. Standard deviation. This measures how much the returns deviate from the mean. A higher standard deviation indicates greater volatility. To calculate parametric VaR, you can use the formula text VaR equals text mean plus z times text standard deviation, where z corresponds to the z-score for your chosen confidence level, e.g., 1.645 for 95% confidence. This method assumes that returns follow a normal distribution, which may not always be the case. While it's quick and straightforward, the assumption of normality can lead to underestimating actual risks during extreme market conditions. Historical simulation VaR. Historical simulation VaR takes a different route by using actual past return data to estimate potential losses. This method reflects how a portfolio would have performed under historical conditions, providing a more realistic view of risk. Data collection. Gather historical price data for your assets over a predetermined timeframe, usually several years. Returns calculation. Calculate daily returns based on price changes. Loss calculation. Sort the returns from worst to best and identify the percentile corresponding to your confidence level. For example, if you're using a 95% confidence level, look for the loss that is worse than the worst 5% of returns. This approach has the advantage of incorporating real market conditions, making it particularly useful in volatile markets. However, it may not account for events that have not occurred in the historical data, leading to potential blind spots. Monte Carlo simulation VaR. Monte Carlo simulation VaR employs a more dynamic approach. It involves generating a large number of hypothetical price paths for the assets in your portfolio, using random sampling techniques. Modeling returns. Create a model that simulates future asset returns based on their historical performance and statistical characteristics. Simulation. Run thousands of simulations over the specified time frame. Each simulation gives a different potential outcome. Analysis. Analyze the results to determine potential losses, focusing on the worst-case scenarios at your desired confidence level. The Monte Carlo method is versatile and can accommodate complex portfolios with nonlinear relationships. It captures extreme events better than the other methods but requires more computational power and expertise. Understanding these different types of VaR calculations allows you to choose the right method based on your risk management needs. Each approach offers unique insights, helping you make better investment decisions and manage your portfolio effectively. Which method aligns with your investment strategy? Calculating value at risk, VaR. Understanding how to calculate value at risk, VaR, is crucial for effective risk management. It empowers investors and financial professionals to grasp potential losses and make informed decisions. Let's break down the data requirements and work through an example calculation of VaR. Data requirements for VaR calculation. Accurate VaR calculations rely on specific data inputs. Collecting the right information is essential for producing reliable results. Here are the key data requirements. Historical price data. Gather historical price data for the assets in your portfolio. This data should cover an adequate time frame, ideally spanning several years. Returns. Calculate the returns for each asset over your chosen time interval, such as daily or weekly. Confidence level. Decide on the confidence level you want to use. Common choices are 95% or 99%, indicating how confident you are that losses will not exceed a certain level. Time horizon. Specify the time frame for your calculations. This could be 1 day, a week, or longer, depending on your risk assessment needs. Portfolio composition. Understand the makeup of your portfolio. Are there multiple asset classes? Knowing this helps in more complex calculations. Collecting this data is your first step towards an accurate VaR calculation. Without it, your risk estimates may fall short. Example calculation of VaR. Let's walk through a practical example of calculating VaR using the parametric method for clarity. Gather historical data. Assume you collected 2 years of daily returns for a stock. Calculate the mean. Suppose the average return over this period is 0.1%. Calculate the standard deviation. Imagine the standard deviation of the returns is 1.5%. Set confidence level and time horizon. Let's use a 95% confidence level and calculate for 1 day. The z-score for 95% confidence is approximately 1.645. Apply the VaR formula. Using the formula for parametric VaR. Text VaR equals text mean z times text standard deviation. Plugging in the numbers. Text VaR equals 0.1%, 1.645 times 1.5%. Text VaR equals 0.1%, 2.4675%. This results in text VaR equals 2.3675%. This means that there's a 95% chance that you will not lose more than 2.3675% of your investment in a single day. Calculating VaR doesn't just provide a theoretical value, it helps frame your understanding of potential risk. By analyzing these calculations, you can better navigate investment decisions and manage your risk exposure. How will you apply this knowledge to enhance your investment strategy? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.